Now we know that the South African banks are tightening their purse strings on lending. This is very much in the light of the declining affordability position of the South African consumer. What does that mean, the declining affordability position of the consumer?
Again, it's not as complicated as we make it sound. So really, in order to qualify for a bond these days, you need to do an assessment, which is what we call an affordability assessment. But quite simply what that is, it's we look at the income that you earn, less all your expenses, and the amount left over has to be enough to meet your bond repayment. So if you make 100 Rand and you've got 90 Rand of expenses, the 10 Rand that's left over, that must be the amount that you can use to pay off your bond. So effectively what we're saying is that that 10 Rand, in my example, seems to be getting smaller and smaller for most consumers. And the reason for that is that costs generally, whether it's electricity, whether it's petrol, are going up quicker than people's salaries are going up.
Yeah, general
so the
living
10's becoming
expenses.
9 or 8 or 7,
Yes.
unfortunately. So people can afford, where they could afford a home for the bond repayment of 10, they can now only afford a home with a bond repayment of 7. And that means that affordability is getting more and more challenging.
And are the banks getting stricter on the granting of home loans?
So banks aren't necessarily getting any stricter. I think the consumer's just under more pressure. So the banks haven't really changed anything. If in fact, they're probably looking for more and more business at the moment. The home loans is quite a profitable part of their business at the moment, so they're desperate to take on more consumers. The problem is the consumer just can't meet those thresholds of affordability, if you want to call it that. They can't get over that, that number that they have to have that's available after their expenses. And that's causing the challenges that we face in the market at the moment.
Is it advisable for a consumer to use more than one bank when applying for a loan, or does it work the other way around? Should they only be using one particular bank?
So, I mean, one of the key parts of our provision of services we give to the home buyer, outside of helping them structure the deal, etc., is that we have contracts with 9 different banks. So, a key proponent of what we do is we take people to 9 banks simultaneously through our electronic systems, and we bring them back quotes effectively from all 9 banks. And it is essential in this market at the moment because banks are looking at credit so differently, bank by bank, as well as pricing so differently. So, the rate that you get from Bank A can be very, very different to what you get from Bank B. So it's important to shop around at the moment, and that's effectively what we do. We help a customer shop around to, as I say, up to 9 different banks.
And that takes a lot of pressure off the consumer.
Correct.
The fact that you are going to be doing the shopping around, you're going to be finding the quotes, you're going to be
100%.
Finding the interest rates, all of those things.
So the customer deals with one person at Uber. We get all the information together for them. We do the application for them. We submit it to 9 banks seamlessly for them. We come back to them with quotes, and then we help them select the bank that we think is going to be the best deal for them based on what credit they get from that bank, what price they get from that bank, and what the terms and conditions of the deal are. So effectively we do everything for them, as opposed to you having to walk into 9 branches and do 9 applications. It's a much simpler process.
Is affordability on the consumer side the only obstacle that bond originators are facing in terms of bond applications?
The other big challenge is customers who have credit problems. So obviously a bank will not grant you a home loan if there's a history of poor credit. So about 45% of active consumers at the moment have got credit-related problems. So either a judgment, an adverse, or they're behind on their payments of 3 months or longer. And we're finding probably about half of the declines that we get are a result of judgment or credit problems with the credit bureau.
Banks are also seemingly making lower offers to consumers, and consumers are having to come up with higher deposits.
Yeah.
Are you seeing that consumers are being able to meet the high deposits that banks are wanting?
So maybe just to put that in perspective, so the lower offer, so often we get a customer who asks us for a 100% loan. The bank will give them a loan, but they say we'll only give it to you at 90%. So you've got to find a 10% deposit effectively. And that happens in probably 30 or 40% of cases at the moment. And we are finding customers really struggle to find that deposit. About 35 or 40% of our consumers, where they fall into that position, are able to find the deposit. The other 60 odd are not able to, and the loan actually falls away and the deal falls away, unfortunately. So it's a struggle for people to find those deposits at the moment.